How is everyone doing? Welcome back to another episode of the Banker Next Door. I am your host, Dr. Joe Berquist. So this is our Labor Day special for 2025. Doing something a little different today. We're actually doing a little bit of a read-along. We're going to be reviewing the book MoneyGPT by James Rickards. And I'm going to be focusing specifically on chapter 2 of the book, which is a story based on a hypothetical bank run caused by AI. So this is going to be a little bit of a longer episode, but I hope you'll hang in there till the end because I'm hoping that you will find this story rather entertaining. But as per kind of the typical book reviews that we do, so this book is I'll just run through some of the basics here at the beginning. So this book is MoneyGPT, and it's called AI and the Threat to the Global Economy. It's written by James Rickards. So the book was written in 2024, last year. It was published by Penguin Random House. The book's approximately 170 pages, so not very long. And this book explores the impact of AI on global financial markets, highlighting its potential to both enhance efficiency and trigger catastrophic economic disruptions due to its lack of human judgment. Now, James Rickards, just a little bit about him if you don't know anything about Jim. So Jim is the editor of Strategic Intelligence, a financial newsletter, and the best-selling author of the New Great Depression, Aftermath, The Road to Ruin, and Currency Wars. Currency Wars is an absolute business classic. I recommend it to anybody. I think it's a must-read. I think any business student in any college today, you should absolutely read Currency Wars. And I will be doing a long review of Currency Wars in the not too distant future. Jim is also an investment advisor. He's a lawyer. He's an inventor and an economist. He has held senior positions at Citibank, long-term capital management. That's a wild story. I'll be doing another episode on that someday here. Caxton Associates. Jim has also been involved very heavily with the government. Jim, helps the government with war games, but a very particular kind of war games, financial war games. And that's really what the book Currency Wars is all about. And so Jim is a very, very fascinating individual. I love listening to Jim. If you guys have ever seen him, he has, been on a number of shows over the years. And like I said, if you ever get a chance to see him or check out any of his stuff, I highly, highly recommend you do it. So now, just real quick, a little bit of background here. So what does GPT stand for? It stands for Generative Pre-trained Transformer. So it emerged over the course of 2017 to 2022 in versions such as GPT-2 and GPT-3 from OpenAI. It was released to everyone in November of 2022 when OpenAI released ChatGPT. OpenAI just released GPT-5. So again, just a little background there. Now, this book, MoneyGPT, it has 5 chapters. So chapter 1 is the end of the markets. Chapter 2 is banking mythos. Chapter 3 is moneyness. Chapter 4 is national insecurity. And chapter 5 is future failure. Now, the chapter I'm going to focus on here today is banking mythos. I may come back at a later date and focus on the first chapter, the end of markets, because that's a hypothetical story about, basically the collapse of the stock market or global stock markets, through AI. And then he talks about moneyness, which again is a very interesting chapter looking at, what really is money in a world of AI. So again, a very fascinating thing. The national insecurity chapter will scare you to death. That is all about basically potential nuclear war and national security and what role AI could play in potentially launching nuclear weapons from one country to another. So yeah, if you don't want to sleep at night, read chapter 4. So okay, then that brings us down to chapter 2 here. So banking mythos. So again, quick summary here. So this is the unstoppable bank run. We're going to talk about a recent example in SVB and their collapse in the spring of 2023. And then the chapter ends up at the end with AI GPT in the world of bank panics. Now, I'm gonna do my recommendation, which I would normally save to the end, but I'm just going to do this up front. So So this book is a very thought-provoking read on the opportunities and threats posed by AI in the global financial markets and geopolitics. AI can provide a lot of potential efficiencies, but it is also fraught with great danger. This book should be read by bankers, financial professionals, politicians, and students. So yes, I highly recommend this book. Definitely go out and get a copy of it if you get a chance. I think you will find it. Highly entertaining. But with that being said, let's proceed here. Let's go into our read along, as it were. So, in this chapter, we consider how other AI GPT applications could cause a bank run that spreads like a virus into full-scale liquidity crisis. For this purpose, there's no need to create a colorful case. We have recent real-world examples that illustrates how bank runs emerge and presage a worse crisis that will be amplified by the proliferation of AI and GPT. AI is widely deployed in banking and has been for years. For example, digital customer assistance robots are used extensively, even if they do not have the next generative capacity of the most advanced GPT models. When you go to an ATM to withdraw $1,000 and the machine asks you if you would like 20 $50 bills or a blend of 650s, 10 10s, and 30 20s, that's AI at work. When you go to your online banking portal and the machine asks, "May I help you?" and then leads you through a series of prompts, questions, and answers, that is a digital assistant based on AI and a less advanced form of GPT. At a more critical and potentially dangerous level, AI and increasingly GPT are embedded in the risk management, trading, and decision-making apparatus of the 21st century banking system. Instead of crunching numbers pulled from the regulatory reports and put into spreadsheets to determine the soundness of a particular bank, an asset manager could simply ask a GPT digital assistant, "Is it safe to deposit money in the Iger Bank?" The digital assistant will scan thousands of pages of regulatory reports, news articles, interview transcripts, and Wall Street analyst reports, among other sources. Indeed, a robot dedicated to financial analysis would likely have scanned them before the question was asked. The robot would then compute conventional ratios, such as liabilities and to total capital, current assets to current liabilities, deposits to liquid assets, and U.S. Treasury securities to total assets. It would look at the size of excess reserves on deposit at the Federal Reserve, changes in bad debt provisions, interest margins, return on equity, and the like. The robot would also look at regulatory history, fines and penalties, recent changes in auditors, pending litigation, and more. The most advanced GPT models would look at important new tests that are not likely to loom large in training materials, such as the ratio of uninsured deposits to total deposits, as a good predictor of the likelihood of a run on the bank. Despite the large amount of training materials and publicly available resources with advanced modeling and massive processing power, this digital due diligence might take mere minutes, at which point the robot could answer no and then produce a 20-page research report explaining why. After identifying an institution to which the robot gave a yes reply, the asset manager would place her funds there. As far as it goes, that type of interaction with the robot analysis is inefficient. A human analyst would likely have, with robot analysis, it is efficient. A human analyst would likely have reached the same conclusion on Iger Bank after days of gathering the same documents, calculating the same ratios, and considering the same risks. GPT in this context is just a speed reading plagiarist, a characterization shared with me by a retired big tech CEO. Yet sometimes a speed reading plagiarist is just what you need to get the job done quickly. The danger arises when thousands of asset managers of multi-billion-dollar portfolios are all using the same technology at the same time. A GPT assistant will reach the same no conclusion on Iger in every case. Those with deposits will withdraw them quickly. Those looking to place funds will look elsewhere, slowly at first, then suddenly. In Hemingway's classic formulation, a silent run on the bank will begin. Many of us have vivid recollections of grainy black and white photos from the 1930s of bank depositors in overcoats and fedoras lined up around the block, waiting to enter a failing bank to get their money out. Most didn't make it inside the door before most didn't make it inside before the doors were shut. In those days, before deposit insurance, your money was gone. Those images were true. Thousands of banks failed in the Great Depression. Financial distress reached a peak in the winter of 1933 and got so bad that newly inaugurated President Franklin D. Roosevelt closed every bank in the country by executive order using the euphemism bank holiday. And yes, that actually did happen. And let me show you guys right here. So I did. One of the things I put in here was this classic picture from Jimmy Stewart in A Wonderful Life while all the people in the town were doing a run on the bank. So that's why I put that in there. So, but yes, the bank holiday is a real thing. That did happen. What is less well known is that in many cases, insiders and friends of bank management had time to get their money out of failed banks before word spread. Social media did not exist then, yet word of mouth did. Once a bank insolvency rumor started, it spread rapidly from neighbor to neighbor and the lines formed. By then, the insiders had their cash in a home safe or stuffed in a mattress. Those in line were the last to know. Technology has come a long way since the 1930s. Still, dynamic is no different, just faster. Insiders still know what's going on before the public and move their money first or dump failing bank holding company shares, and there are no more lines around the block. Instead, the news of distress spreads instantly by text and TikTok. While you're texting a fellow tech startup CEO to get his money out, the AI link to your iPhone is exploring virtual world clouds in token form and suggesting run on the bank faster than you could type it. You tap the text prompt, hit send, and your warning is on its way. Once your friend gets the message, he opens the institution level app for the bank in distress, enters the password, and initiates a 1 million transfer to Bank of America, considered too big to fail. Your warning and your friend's transfer takes seconds. The transfer settlement goes via Fed wire, and the funds are available at Bank of America in an hour or less. Like the research report on Iger Bank, this all seems neat and tidy and above all convenient. What's missed, at least initially by the customer, the media, and regulators, is the speed and scale of the process. If you were alerted quickly and texted your friend just as quickly, you can be certain that tens of thousands of such warnings and billions of dollars of transfers were taking place at the same time. The bank is stripped bare of cash in hours. Securities cannot be sold fast enough or in sufficient quantities to make up for the cash demands. The bank figuratively closes its doors in a day or two. By 6 p.m. Eastern Standard Time on the second day of the bank run, the FDIC issues a pro forma press release with a few tweaks for the name and date on this particular failure, reassuring depositors that their money is safe. The difficulty is that a bank run never involves just one bank, however large. Even Goldman Sachs and Morgan Stanley were bailed out in September 2008 through their near instantaneous conversion to bank holding companies eligible for Federal Reserve liquidity facilities, a conversion process that can take years in non-emergency conditions. The reality is a cascade of failure where one bank closure leads depositors to question their own banks and demand cash or wire transfers to money market funds. The bank run dynamic repeats itself all over the system as it did in 1933, regardless of deposit insurance. Sooner rather than later, the FDIC solvency is called into question and deposit insurance is regarded as an empty promise. None of this is hypothetical. The financial realm came within hours of closing every exchange in the world before the long-term capital management rescue finally settled on September 28, 1998. A domino-like chain of bank failures as well underway before the Fed issued blanket guarantees and converted brokerages to banks in September 2008. What's new is the immersion of market participants in a digital haze of AI, portable devices, wireless communication, social media, texting, and delegation of decisions to GPT, which instantly propagates what everyone already knows: take the money and run. Regulators still have not learned the lessons of 1998 and 2008. The Fed put an understanding by investors that the Fed will buy securities in distressed markets is alive and well. They've read about AI GPT, but don't understand its power. Bank runs are not about capital ratios and liquidity. They're about confidence and psychology. Walter Wriston, the second greatest banker of the 20th century after Pierpont Morgan, once told me banks don't need capital to function smoothly. They just need interbank deposits, Eurodollars, to conduct business and meet their obligations. That's true, with one caveat: the Eurodollar market itself can break down when confidence in the creditworthiness of banks themselves is lost. All of these lessons and the UR model for ending distress are found in the Panic of 1907. These lessons are lost on regulators and are opaque to the tech mavens texting traders to move their money fast. The banking system, which is intrinsically fragile, is more fragile than ever. We're counting down to a crisis so large, even the Fed cannot contain it. It likely started already in Santa Monica, California. So, the financial arena is still recovering from the failure of Silicon Valley Bank, SVB. This failure is a real-world example of the dense connections and complex dynamics that make the banking system a meltdown waiting to happen in the age of AI/GPT. SVB was a commercial bank based in Santa Clara, regulated by the Federal Reserve System and insured by the Federal Deposit Insurance Corporation, the FDIC. It was the first bank run amplified by AI GPT. On Friday, March 10th, 2023, the FDIC abruptly closed the bank, moved some deposits to a newly created bank controlled by regulators, wiped out large depositors, and began a process of selling bank assets and repaying creditors. At least that's what the FDIC said on March 10th. By Sunday, March 12th, 2023, the story had changed 180 degrees. In a joint statement, the Federal Reserve System, the Fed, the U.S. Treasury, and the FDIC said deposits would not be wiped out after all. All deposits would be fully insured regardless of amount. The $250,000 limit on FDI insurance was shredded. There was now no limit. Some accounts had as much as $3 billion on deposits with SVB. The government said, in effect, no problem, and promises to keep the entire amount protected. As part of that weekend's emergency response, the Fed created the Bank Term Funding Program, also known as the BTFP. This program allows any bank to send its treasury notes and mortgage securities to the Fed in exchange for cash. The cash amount would be 100% of the par value of the securities, even if their market value were 30% lower. Bonds with a $1 billion original value could be pledged to the Fed for that amount, even if they were worth only $700 million in market value at the time. This under-collateralized loan would be for 1 year at a rock-bottom interest rate. By the time the dust settled on Monday, March 13th, several momentous developments had emerged. This emergency rescue was bigger than the 1980 savings and loan crisis, about $150 billion. The 1998 long-term capital management rescue, about $4 billion. The 2008 global financial crisis, over $4 trillion added to the Fed's balance sheet, and the 2020 pandemic panic, over $6 trillion added to the Fed's balance sheet. This was the largest financial bailout in history. The March 12, 2023 bailout was not just a bailout of SVB, it was a bailout of over 50,000 SVB depositors with over $170 billion in deposits. It was a bailout of SVB's customers, its employees, their suppliers, and the entire high-tech startup ecosystem in Silicon Valley and around the world. It was a bailout of the billionaires and high-powered venture capital firms that owned those startups. And while the Fed may not have intended this, it was also a bailout of the $1 trillion cryptocurrency market. This story is not a one-day wonder. The ripple effects of the SVB collapse will continue for years. In complex dynamic systems, including the banking and capital markets, it is impossible to know in advance exactly which firms will fail next. It is nearly certain that such failures will arise. Consider a timeline of events that provides us with a baseline for considering the more technical aspects of the bailout, the corruption going on behind the scenes, and the role of AI GPT will play in the next stage of the panic. The SVB collapse is the bitter fruit of 8 years of zero interest rate from 2008 to 2015 under Fed chairs Ben Bernanke and Janet Yellen. That zero interest rate policy and the accompanying $4 trillion of money printing called quantitative easing created an age in which investors were forced to channel savings into riskier assets such as stocks, real estate, and emerging markets in a search for yield. The resulting asset bubbles were amplified with borrowed money in the form of carry trades and derivatives. No one cared about the potential for higher interest rates and monetary tightening. That seemed to be off the table. Investors were driven by what's called TINA. There is no alternative, and FOMO, fear of missing out. These are, you got to love these acronyms. These are exactly the kinds of subjective behavioral factors that AI GPT cannot easily capture or comprehend. The day-to-day chronology specific to SVB begins on February 27th, 2023, when SVB CEO Greg Becker dumped 3.5 million of SVB stock. On the same day, the bank CFO Daniel Beck dumped 575,000 of the bank stock. Both executives claim these sales were pursuant to pre-announced programs allowed by the SEC. Still, SVB's unrealized losses, unknown to the public at the time, dated back years. So the prearranged selling program may itself have been cover for what they both knew was coming. The SVB stock price at the time of those sales was about $290 per share. Today, it is worthless. The insiders got out in time. So again, remember what we talked about at the very beginning, where we talked about during these bank runs in the 1930s. What happened? The insiders, they all got their money out first. If you were one of the customers waiting in line on the street, it was too late. You were the last to know. And once again, what do we see here? Since 1930 to 2024, or 2023 rather, nothing's really, technology's changed, but nothing's really changed. The insiders are still getting their money out. And I would also tell you that there are a couple of reports that I have reported on. So some of the regulators have already had a chance to go back and look at the failures of SVB in 2023. And it came out that basically regulators knew that they had a problem with unrealized losses in their bond portfolio going back to the third and fourth quarters of 2022. And these executives had been warned by those regulators of these issues. So we know that these guys already knew that there were major problems. They had been warned. They were told to fix this stuff. They didn't do anything about it. And, and then we're supposed to believe that, oh, this just happened on February 27th. And then, 2 weeks later, the bank's out of business, oh, it's just such a coincidence, right? But anyway, I digress. Okay. So on March 1st, 2023, the ratings agency Moody called SVB management to tell them that Moody's was considering downgrading the bank's credit rating. This set off alarm bells inside SVB. Management knew that a credit downgrade might start a flood of deposit withdrawals and a crash in the stock price. Becker immediately called Goldman Sachs to work out a financial rescue plan. The hope was that a credible plan might cause Moody's to change its stance on the ratings downgrade. In its simplest form, SVB's problem was the classic banking blunder of borrowing short and lending long. In SVB's case, this meant taking a short-term deposits from customers and investing them in long-term treasury notes and bonds with maturities of up to 30 years. By December of 2022, SVB had $173 billion in customer deposits, $74 billion in loans, and $120 billion in securities. So the securities included held to maturity, also known as HTM, account of $91 billion and available for sale account of $26 billion. The available for sale securities have to be marked to market to reflect changes in market value. The HTM account did not have to be marked to market. SVB had 76% of its securities in the HTM account. The norm for large banks is 6%. Let me say that again. The norm for large banks is 6%, and they had 76% of their securities in the HTM account. The idea of HTM was that if you hold securities to maturity, you'll receive all your money back. Therefore, daily fluctuations in value can be safely ignored. SVB took that rule to extremes in order to abandon responsibility for actively managing market risk. Still, banks need to exercise some risk management over all their assets, including its HTM account. That's just prudent banking. SVB had completely deficient risk management. The risk management officer position at SVB was vacant for 6 months leading up to the fiasco. It's just like, you can't make this up. The UK risk management head spent extensive time on diversity issues and seemed to spend little time on risk management. SVB was paying as much as 4.5% interest on deposits at a time when most Americans were lucky to get 1%. Another example of reckless risk management. As a result, SVB seemed not to realize that the Fed raised interest rates beginning in March of 22. The value of its bonds would decline. That's bond math 101. So SVB relied on the HTM accounting rule and assumed that losses on that $91 billion in bonds would remain hidden because there was no mark-to-market accounting. This plan fell apart when billions of dollars of deposits began to flee the bank. Whether large depositors had inside information or had heard about the bank's Moody's downgrade threat is not known, but leaked information seemed the likely culprit. The deposit withdrawals were so large that SVB had to sell billions of dollars worth of bonds to meet the withdrawal obligations. Once the selling began, the mark-to-market rules applied. The losses would quickly come to light. See, this is it's like a domino effect. The dominoes all going down. So SVB, Moody's, and Goldman worked frantically over the weekend of March 3rd to March 5th to devise a rescue plan. That plan would work as follows. SVB would sell $20 billion of its low-yielding bonds and reinvest the proceeds in newly issued higher-yielding bonds. When it sells its HTM bonds, the exception to mark-to-market rules no longer applies, and the bank must recognize the full loss immediately. The bond losses turned out to be $1.8 billion. Since SVB is a public corporation and a highly regulated bank, that $1.8 billion loss had to be reported to the public. The public disclosure occurred on Wednesday, March 8th, 2023. SVB planned to plug that $1.8 billion hole in its balance sheet with a new $2.5 billion stock issue. Goldman lined up private equity giant General Atlantic to commit to $500 million of that amount. Other potential investors were in discussions to buy more. Moody's announced the ratings downgrade on March 8th, but the downgrade was mild because of the bond sale and reinvestment plan, part of the Goldman plan. SVB and Goldman raced to complete the capital raise to mitigate the damage of the bond portfolio loss. Then the capital raise plan blew up. The hope was to announce the capital raise completion before the market opened on Thursday, March 9th, but SVB was incompetent at getting non-disclosure agreements signed so that potential investors could examine the books. Investors said they needed more time to do due diligence given the size of the Wednesday losses. Meanwhile, the Wednesday loss announcement caused SVB stock to plunge from $268 per share to $172 per share in after-hours trading. When the market opened Thursday, the shares fell to $106 per share, a stunning 60% crash from the Wednesday close. Goldman still hoped to close the deal at $95 per share, but it was too late. Trading in the stock was halted on the NASDAQ. General Atlantic walked away from the deal, and the stock offering collapsed. Venture capital firms and others urged their startups to get their money out of SVB as soon as possible. $42 billion of deposits were withdrawn on Thursday alone. On Friday, March 10th, 2023, California bank regulators closed SVB and appointed the FDIC as receiver. The FDIC issued a press release that day stating that only accounts of $250,000 or less were protected. All other deposits would be eliminated and depositors would get a receivership certificate. Distributions on the certificates would depend on future sales of assets by the FDIC. That process would take weeks or months. In the meantime, the certificates were illiquid and of uncertain value. Uninsured deposits were simply gone. Then, like Dracula, the deposits rose from the dead. An explanation for that requires knowing the difference between a bailout and a bail-in of depositors in a bank panic situation. One of the most fascinating aspects of the SVB collapse and the bank runs that soon occurred elsewhere is how quickly global bank regulators abandoned carefully worked out bail-in rules and reverted to a weird hybrid of bail-in and old-fashioned bailout. The putative result was a short-run calm. The real result was total confusion among bank depositors and a further loss of confidence in the banking system as a whole. The explanation for this bail-in, bailout discussion takes us back to the period from 2008 to 2014. SVB was the first application of a financial regulatory rule the G20 put in place in November of 2014 in the aftermath of the 2008 financial crisis. There was a popular outcry against using taxpayer money in 2008 to bail out bank CEOs who were making millions of dollars and whose banks were and are still around. In response, the G20 agreed that in future financial crises, there would be no more bailouts without taxpayer money. The new approach was called a bail-in. This means that in the case of a failed bank, equity would be wiped out first, then depositor funds would be converted to contingent claims if they were above the insured amount. Bank deposit insurance is $250,000 per deposit in the United States and $100,000 per account in the EU. Only insured accounts would be fully protected. Over 93% of the deposits in SVB exceeded the insured amount. This means those deposits were gone, according to the FDIC's press release on March 10, 2023, and consistent with the G20 bail-in plan. Depositors were to get receivership certificate from the FDIC, which may or may not have been worth anything, depending on what the FDIC might collect from asset sales. It could take months to ascertain the size of the SVB losses and a year or longer to sell assets. Depositors might ultimately get 90 cents on the dollar or 10 cents on the dollar. No one would know until the FDIC computed the size of the hole in the SVB balance sheet. The losses would get worse as the fire sale proceeded and asset values dropped further. The systemic problem was that those lost SVB deposits represented venture capital investments and working capital balances for thousands of tech startups and early stage tech companies. They would have no cash to spare. This meant they would not be able to make payroll, pay the rent, pay vendors, or conduct business. Those tech firms would likely fail, tens of thousands would lose jobs, and the ripple effects would spread out from there. The issue of contagion from SVB is interesting and not well understood. Everyone was worried about other banks failing. Still, that's far from the only kind of contagion. Consider this. Silicon Valley companies and tech firms around the world held in portfolio by SVB would see their stock prices decline as the FDIC conducted a fire sale of assets to pay creditors. Buyers would lose lower bids, knowing the FDIC was desperate to raise cash. There's an unhealthy tension between how quickly you dump assets and how much you could get for them. Generally, a slower approach gets higher prices, yet that slow approach may strangle the startups. Top VC firms warned startups that if their money was lost in SVB, they would not get new funding from the VCs. Instead, they would fail. The FDIC announcement of a depositor bail-in held sway for 48 hours. Around 6 p.m. on March 12th, a joint announcement by the Federal Reserve, FDIC, and the U.S. Treasury said in effect, "Just kidding." The bail-in was abandoned. Instead, the regulators announced that 100% of deposits at SVB would be protected in full. The bailout was back. The 2014 bail-in rules, which had been in place for 9 years but not called upon until now, were thrown into the tall grass in 2 days. This was clearly a bailout of Silicon Valley, but the story is bigger than that. Depositors at SVB that were tech startups and even mature companies were bailed out when the FDIC abandoned the $250,000 deposit insurance limit. But those companies had their own investors, large VCs and high net worth individuals, and they were the real bailout beneficiaries by not having to take losses on those investments. Not only that, but the entire banking system was bailed out by the March 12th announcement because the Fed invited any member bank to deliver underwater treasuries and mortgage securities and get 100% cash for the full par value of the bonds, despite the fact that many bonds were deeply underwater on a mark-to-market basis. The Fed, FDIC, and Treasury credibility on the subject of bailouts is now in shreds. SVB was a bailout of monumental proportions, which mainly benefited tech entrepreneurs, wealthy investors, and banks. Secretary of the Treasury, Janet Yellen, said the bailout did not involve taxpayer money. This was false for 2 reasons. $25 billion of the bailout money was from the Exchange Stabilization Fund, also known as the ESF. Created in 1934 after FDR confiscated gold from everyday Americans at $20 per ounce and repriced it at $35 per ounce. That's a 75% markup profit for the government taken from Americans' pockets at the time. The ESF has been growing ever since, and Treasury can use the money without congressional authorization. More to the point, the rest of the bailout money came from the FDIC insurance fund. The fund was badly depleted by the SVB and other bailouts. It was replenished by increased FDIC insurance premiums on banks. The banks will pass the insurance cost along to consumers in the form of lower interest rates or higher fees. So in the end, the everyday American always pays. The cost is simply laundered through the FDIC. The new banking crisis was by no means limited to the California tech world. On March 16, 2023, after long struggles with loan losses, customer fraud, and poor risk management, Credit Suisse received a bridge loan of 50 billion Swiss francs, about 54 billion in US dollars, from the Swiss National Bank to provide liquidity while other measures were considered. On Sunday, March 19th, SNB announced a shotgun wedding between UBS and Credit Suisse. UBS acquired Credit Suisse for only 1% of its peak share price. Credit Suisse shareholders were largely wiped out, but did receive a $3 billion sliver of proceeds from UBS. The financial damage of the Credit Suisse failure ran far deeper than stockholder losses, which, after all, are expected in a failure of this type. A certain kind of bank capital called AT1 was also wiped out. This consisted largely of so-called COCO bonds, short for contingent convertible. COCO bonds are high-yield debt that is automatically converted into equity when a bank is in distress. That might be an acceptable outcome when the bank survives, but when the bank fails, the COCOs get wiped out along with the rest of the equity. COCO bondholders in Credit Suisse lost $17 billion. Yet mark-to-market losses in the larger world of AT1 credits were over $275 billion as investors lost confidence in the entire asset class. The biggest losers in the Credit Suisse COCO wipeout were PIMCO, $870 million, and Invesco, $370 million. Losses on the Credit Suisse COCOs were a hybrid of a bail-in approach because taxpayer money was not involved, and a bail-out approach because shareholders were not wiped out completely before the COCOs were crushed. This mixed bail-in, bail-out result just added to the confusion around what happens when the next bank fails. The ripple effects of the huge losses and uncertain outcomes are still spreading through the international banking system. Yes, we're still seeing ripples of this, today. The broader meltdown arguably began with Bitcoin in November of 2021, when it proceeded to crash 78% by November of 2022. That caused what cultists called the crypto winter and a cascade of failures in crypto land. These failures included Three Arrows, a crypto hedge fund, Genesis, a crypto exchange and custodian, FTX, obviously Sam Bankman-Fried, another crypto exchange and custodian, and Alameda, also Sam Bankman-Fried, a crypto hedge fund associated with FTX. As these failures cascaded, the larger issue was whether the crypto contagion would spill into mainstream banking. If the financial virus remained in crypto land, it could cause enormous damage, but not a full-scale financial panic. If the virus spread into mainstream financial channels, conditions could get far worse. On March 8th, 2023, we got the answer to that question. Silvergate Bank announced it was filing for bankruptcy protection. Silvergate was the bridge that carried the virus from crypto land to mainstream banks. Silvergate was a mainstream bank with FDIC insurance and bank regulation. It was also knee-deep in crypto transactions, including crypto loans and funds on deposit with failed crypto exchanges. Silvergate closed its doors and announced an orderly liquidation. Now the crypto contagion had spread to conventional banking. SVB was Silvergate's first victim in the mainstream banking system. So let me just explain something real quick. So Silvergate Bank was a much smaller, it was about $10 billion in asset size, but Silvergate Bank was owned and operated by a hedge fund, Silvergate Capital. Silvergate also they operated what was called the SEN network, the Silvergate Exchange Network. That was the main rail system that went between the crypto world and the bank. So that was the main rail system that ran between that. And when FTX imploded, they basically, all these, in order to cover the bad bets in FTX, they started siphoning all the deposits out of Silvergate. So Silvergate was the first run. The next two, the backup crypto banks, if you will, were SVB and Signature Bank in New York. So it was like a domino effect. Silvergate closed the exchange network on March 3rd, which he doesn't mention in the book here, but that's what happened. So March 3rd, they closed the SEN network. 5 days later, on March 8th, they closed Silvergate Bank. That gets shut down. And then on the 10th, you get SVB. And then on the 12th, you got Signature. So it just went like a bunch of dominoes. Boom, 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 boom. And that's the timeline of how this whole thing rolled out. So-called crypto stablecoin sponsors kept large cash balances in SVB. A stablecoin is a cryptocurrency that claims to maintain a constant value of $1 per coin. Sponsors do this by taking proceeds from buyers, issuing the coins, and investing the proceeds in bank deposits, U.S. Treasury bills, or other high-quality cash equivalents. The two most popular stablecoins are Tether and USDC. Liquid assets were needed to meet redemptions if stablecoin holders wanted their money back. Those balances at SVB were seen to be at risk, so the stablecoins started melting down. Stablecoins are a 200 billion market and the backbone of the entire crypto world. About 70% of Bitcoin purchasers buy Tether first and then buy Bitcoin with Tether. If Bitcoin holders want to bail out, many have to sell Bitcoin for Tether and then redeem the Tether. The Bitcoin crash becomes a Tether crash. That's contagion in action. The difficulties begin with the fact that stablecoin issuers have never been transparent about where they invest their dollar sales proceeds. There have been no audited financial statements or detailed disclosures. One partial disclosure from the Tether showed that almost half its dollar assets were in commercial paper and unsecured corporate IOU, with no details on the name or quality of the commercial paper issuer. This leaves open the possibility that the issuer is affiliated with the sponsor or that billions of dollars of funds were improperly diverted. Now those stablecoin concerns have been more acute. USDC had over $3 billion of its cash reserves on deposit with SVB. That money was at risk. By Saturday, March 11th, USDC was trading around 85 cents. That's an extreme meltdown considering the token is promising always to be worth $1. The potential is not only that these stablecoins melt down, but that they take Bitcoin with them because of a mad dash for the exit to dollar liquidity. Exchanges, hedge funds, and crypto banks could all fail alongside the coins themselves. So now we've kind of got the bank panic scenario. We've talked about SVB. Now the last part of the chapter goes into AI GPT in the world of bank panics. So what we are faced with is not merely a banking crisis or a crypto crisis, but a system with recursive functions where a crisis in one world infects the mirror world and feeds back to the source with ripple effects in all directions. It's a result of the complexity that derivatives, leverage, cryptos, deficient risk management, and behind the curve regulators have spawned. Even the most sophisticated AI cannot grasp this complexity. Yet AI can start a crisis by relying on stale training sets or amplify a crisis by responding with added advice to truly unprecedented problems. There had not been a bank failure of the magnitude of SVB since 2008. There has never been a crypto crisis side by side with a banking crisis until now. Regulators are at a loss. They're fighting the last war about depositor bailouts without realizing they are actually fighting a new war of AI GPT channels and crypto panic in digital space. Consider how AI GPT is only slightly advanced form would handle the complex banking failures described above or a similar situation in the not distant future. At an individual level, depositors and asset managers would ask GPT for advice. Prompts would be simple, such as, and this is the investor, so what's going on in the banking system right now, especially with regard to Iger Bank? GPT would respond, the situation is dangerous. Depositors are pulling their money out of Iger Bank as fast as they can. The bank is in danger of failure and at this point is likely to be taken over by the Federal Deposit Insurance Corporation in cooperation with the Federal Reserve and the U.S. Treasury Department. The investor, are other banks in danger? GPT, yes. The history of bank distress is that it spreads from bank to bank. The mathematics are almost identical to models used by epidemiologists. I always epidemiologists. The spread is exponential. I am already reading accounts of other banks that are experiencing similar problems. More bank failures in the near future are highly likely. The investor, which banks will likely fail soon? GPT, I'm displaying a list of 20 banks with total assets between 100 billion and 900 billion and insured deposits to total deposit ratios of less than 30% that are not considered too big to fail and are therefore likely to fail as this current bank run continues. The investor, what should I do with my deposits? GPT, it is possible that government intervention may preserve the value of deposits of any size, even in failed banks, as happened with Silicon Valley Bank. However, there can be no assurance of this outcome. Regulators may decide this is the time to teach depositors a lesson about bank safety and due diligence, or regulators may not have the resources to bail out depositors because the FDIC insurance fund has been badly depleted. The outlook is uncertain, so the best course is to withdraw your funds from the banks on my list and deposit them in banks such as Wells Fargo, Citi, and JP Morgan, or buy treasury notes and money market funds from a broker associated with those banks. Now, the GPT part of this dialogue is a bit stilted. That's to be expected. GPT models are still in training. They've come a long way quickly, but are still getting the hang of idiomatic conversation. That does not detract from the fact that the information provided is solidly based and consistent with what experts familiar with bank runs and financial history would offer. What's news is that the individual is having the conversation with a robot and not an expert. Presumably, the conversation is being repeated hundreds of thousands of times between clients and robots all over the world. Based on human nature and aversion to financial loss, there's no reason to believe the prompts would be substantially different, except in very few cases. Based on algorithms and training sets, there's no reason to believe the replies would vary materially. So in effect, what is happening is GPT is yelling fire in a crowded theater when there actually is a fire. The crowd is stampeding for the exit and some will get trampled. This happens in all bank runs, except now it's happening all at once instead of in stages. No one fits the category of the last to know because everyone knows everything at once, a reality that Marshall McLuhan predicted in the 1960s. Regulators are utterly unprepared for this dynamic. As for regulators, analysts, and politicians, they would be having their own conversations with GPT along these lines. So official. We're witnessing a run on the bank, starting with Iger Bank, but now spreading to others. What should we do in response? GPT. There are several possible responses. The U.S. government could guarantee all the deposits in the banking system and offer to buy any high-quality assets from the banks for cash. This might restore confidence in the banks and stop the bank run. This was done in the case of Silicon Valley Bank. Or you could follow the model laid down by John Pierpont Morgan in the Panic of 1907, which is similar to triage. Banks are divided into three categories: those that are solvent and liquid and likely to survive the panic, those that are solvent but illiquid and need cash to keep their doors open, and those that are both insolvent and illiquid and have no chance of survival without a government bailout. Morgan's approach was to demand the strong banks advance funds to the solvent but illiquid banks. The insolvent and illiquid banks were allowed to fail. This way, the damage was minimized. The deadwood was cleared out, and the panic was soon over. The third approach is to handle the failures one by one with FDIC takeovers and hope that the public sees this as reassuring that the panic subsides. So the official responds, which approach is best? GPT says it is likely that John Pierpont Morgan's approach is best. It does not require government intervention or taxpayer funds. It puts some burden on the most successful banks to help those banks that are worth saving. The banks not worth saving will fail, yet everyday Americans will be protected up to $250,000 each through deposit insurance. As for savers with large deposits in weak banks, they deserve to lose their money for being reckless. It will teach them a lesson for the next time. Moral hazard for the system as a whole will be reduced, and the likelihood of bank failures in the future will be less. So the official says, I can't use the Morgan approach. Voters who lose deposits in the failed banks will vote my party out of office. I could lose my job. It seems better to use taxpayer money to paper the crisis over in ways that few citizens will understand. GPT, I'm sorry to hear that. It's a funny end there, right? Very true, though. In this situation, GPT's considered advice based on training materials that cover every bank failure since the collapse of the House of Bardi and Peruzzi in the 1340s is ignored by policymakers. GPT's solution is sound, fair, and likely cheaper in the long run. The policymaker's answer is short-term and costly, and it disadvantages the largest group, taxpayers, for the benefit of a smaller group, uninsured depositors. In this case, GPT fails not because it is optimizing for the greater good, it is, but because policymakers don't care about the greater good. Finally, and most disturbingly, we consider the role of AI in creating exactly the kind of panic that market participants and regulators are trying to avoid. To the extent that AI mimics human intelligence without being sentient, we have to weigh the output against the shortcomings. AI can help to cure certain diseases, but it will also replicate highly dysfunctional behaviors. Developers say they can control for these adverse behaviors, yet behavioral psychologists themselves don't fully understand them. The claim of computer control rings hollow. The easiest way to understand the pertinent dynamic is to realize that bank runs result from a self-fulfilling prophecy. Banks generally do not mark their assets to market except for assets that are actively traded. When interest rates go up, bond values are not written down even though the market value has fallen. The same is true for commercial real estate loans when valuations drop, and for emerging markets debt when sovereign borrowers become distressed. Some losses are finessed through loan loss reserves, over which management has enormous discretion. Even then, the full extent of valuation losses is not revealed unless there is an outright default. This accounting manipulation means that most major banks are technically insolvent some of the time. Yet bank runs are relatively rare. Insolvency itself cannot be a causal factor in bank runs. Otherwise, they would be far more frequent. A better explanation is illiquidity. When banks cannot meet depositor demands for cash or cannot roll over short-term liabilities in interbank or money markets, the dry tinder for a bank run is in place. This is why the Federal Reserve was created in 1913. Its true purpose is not to manage interest rates or boost employment. It does both incompetently. The real purpose is to be a lender of last resort to illiquid banks. This it does fairly well, as was seen in the creation of the lending facility secured by underwater treasury notes after the Silicon Valley Bank collapse. If insolvency is not transparent or well understood, and if illiquidity is backstopped by the Federal Reserve, then why do bank runs commence? The answer is psychology. Some customers or counterparties come to believe a bank will not repay them, so they pull their money out or close transactions as quickly as possible. They are not reassured by Fed press releases or positive comments by management. Word spreads with withdrawals accelerate, and within days, sometimes hours, the bank closes its doors. From there, it's an open issue whether the lost confidence spreads to other banks in a process called contagion. No amount of capital or comment can stop a bank panic. It has a life of its own. In the 1930s, contagion spread by telephone, telegraph, and word of mouth. In the 1990s, contagion spread by computer screens and TV news. In 2023, contagion spreads by text and Twitter. The process is now faster and more widespread than ever. That's one reason Fed rescues keep getting bigger than the one before. We are now on the threshold of failures that are bigger than the Fed's capacity to calm. Enter AI. The next bank run may be triggered not by human panic, but by AI imitating human panic. An AI bank analysis program that deeply layered neural networks and machine learning capabilities, perhaps complemented by a GPT capacity to speak with human analysts, could read millions of pages of financial data on thousands of individual banks, far more than any team of human analysts could review. Its training set of materials provides familiarity with the dynamics of bank runs, basically an emergent property of a complex dynamic system, along with historical examples, worst-case scenarios, and defensive moves. Even like the gold corner of 1869, the panic of 1907, the Great Depression of the 1930s, and the S&L crisis of the 1980s would all seem as fresh as today's news. The system would reach the same conclusion as a human analyst. Move first, get your money out fast, don't be the last in line. The true danger is not that the machine thinks like a human, it's supposed to. The danger is that it can act far faster and communicate with other machines. Many trading firms have authorized their computers to execute trades based on AI algorithms without clearing the trade with human risk managers. AI trading systems are highly tuned to see what other systems are doing and to react nearly instantaneously. No text, telephones, or TV talking heads are required. Once a meltdown begins, it feeds on itself at unprecedented speed through recursive functions, feedback loops, built into the algorithms. Not only does an AI bank run begin and become contagious faster than a human one, it happens before humans even know it's happening. It happens faster than the Fed can issue press releases and offer happy talk. Theoretically, the panic spreads faster than the speed of light because message traffic, each message at the speed of light, branches hyper-exponentially through thousands of channels. In this situation, there's no possibility of providing liquidity or meeting demand in time. You simply close the banks. Even then, the panic does not subside. AI never sleeps. Once the banks are closed, AI and its deep neural networks scan global markets for alternative venues to sell assets, claim cash, or short the panic. The scramble for cash extends to commodities exchanges, CME Group, Shanghai Futures Exchange, London Metal Exchange, stock exchanges, the NYSE, the NASDAQ, the London Stock Exchange, and insurance markets, Lloyd's of London, China Life, Munich Re, Berkshire Hathaway, and so on. One by one, these firms and markets will suspend redemptions, suspend trading, or close their doors. As trading maven Blythe Masters once observed, the gold market never settles. She was right. It's not supposed to settle. It's supposed to keep going, with individual participants opening and closing positions or rolling positions over. The market itself cannot settle because the volume of open positions is orders of magnitude larger than the amount of physical gold. The gap is bridged by time, credit, time, and trust. The same observation that the market never settles could be applied to stocks, bonds, commodities, or cryptos. An AI panic forces all markets to settle almost at once, an impossibility. The result is that global markets shut down. This is an outcome that regulators, market participants, and developers cannot prevent. This is because the cascade from deep neural networks to the human brain to capital markets has a computational complexity that exceeds the computing capacity of the entire world. It can be understood theoretically, yet it cannot be modeled in a way that can be foreseen, that can foresee every collapse, let alone prevent them. The collapses will just happen. No one will quite know why. So, that is chapter 2 there from MoneyGPT. So we covered an extreme amount of ground going through this chapter. I mean, we talked about, hypothetical AI bank runs. We talked about what actually happened with SVB. We talked about the blurring of this whole notion between a bail-in and a bailout, and where does that leave regulators today? We talked about the speed at which a bank run can take place today and how that affects things. And then finally, we wrapped up by going through some of these conversations that an AI, chatbot could be having with a banker or an investor or a politician, and some of the decisions they might possibly make, and may make those decisions in the interest of self-preservation, not in the financial interest of taxpayers or customers or individual investors. So again, a highly, highly interesting article. It's just a chapter rather. So I hope I know this was a little bit longer episode, but my hope is that people really found this story here interesting. I would encourage everyone to definitely go pick up a copy of the book, MoneyGPT. Read it yourself, check it out. It's not a very long book, but it is a fascinating book. Jim Rickards is a great author, and he has a mind like nobody else when it comes to playing out and thinking through all these kind of very interesting scenarios, wargaming them, if you will. So, okay. With that being said, that was the Labor Day special 2025. I hope everybody enjoyed it. There are, new episodes coming out the rest of the week as they normally would be at, 12 noon every day, Monday, Wednesday, Thursday, Friday. So I hope you guys will go check out some of those episodes. The strategy room will be back this Saturday live at 8 p.m. So please check us out when you have a chance. So I will wrap up by saying, if you like this episode, please make sure to like, share, and subscribe, as it always helps the channel. Remember, we are on YouTube, Rumble, and all major podcast platforms. Please be sure to leave your comments down below, as I love getting back to everybody. And as always, make sure to check out some of the other content on the channel. I hope everyone out there has a great Labor Day. Take care. Thank you for listening, and I will see you again real soon.